we're hosting Lars Vestergaard and JD Weinstein from Oracle for Startups. So welcome everybody. We've got people dialing in from all over the globe, all the way from India to the West Coast, to Canada, across Germany, Europe, France, Dublin. So plenty of people joining from across the globe. So really excited for this event, and had some awesome music as well at the beginning, as requested by Lars. But yeah, really honored to have Lars and JD with us today. So this month, as many of you may or may not know, is Funding Month, and with Startup Grown, we are very much welcome with Oracle for Startups and also American Express as well, running some events too. But here today we've got Lars and JD. So we're going to be here recognizing the stories, lessons learned, and sort of best practices that have been shared by sort of founders and funders globally. So I just wanted to share a very quick video around startup grind. Bear with me. That really summarizes what Funding Month is about.
Funding Month, presented with Oracle for Startups and American Express, recognizes the stories, lessons learned, and best practices shared by founders and funders around the world.
So while we wait for JD to return to us, I'll do a very, very quick introduction. Not that they need any introduction. So Lars is an incredibly well-connected individual, heading up the EMEA Connect part of Oracle for Startups, a really seasoned entrepreneur, and a real super connector, fascinating guy to learn from, full of wisdom, and a great guy to just have an awesome conversation with. So Lars, welcome to the stage. It's an absolute honor to have you here. And JD, dialing in from the US, it's phenomenal to have you with us. You head up the VC funding side of Oracle for Startups. Again, a phenomenally charismatic individual with a wealth of knowledge and experience. So two incredible individuals we've got on stage with us today from Oracle, ready to share an insane amount of learnings that you guys have had along your journeys with our really excited attendees today. So what I would like to do is first allow you both to introduce yourselves, talk about Oracle Startups, and then I'll bring up the presentation, and feel free to get me to navigate for you on your behalf. So I'll hand over to you both for introductions.
If I begin first, I'm Lars. I'm based in Copenhagen, Denmark now. I've traveled throughout the world, worked internationally, worked out of the UK for 11 years. I have had the pleasure of being the managing director of one scale-up enterprise sales in another. It's all about boosting the books. How do you get to a point where an investor, whether a venture capital or a large IT listed company, really needs to pay attention to you? So I look forward to taking part of this session and probably seeding the discussion with that all in. How do you have all of your startup covered when you go to apply for funds and want to woo these venture capitalist guys?
Thank you.
All right, excellent. We can all hear me now. We're solved our tech madness issues. Okay, howdy y'all from Austin, Texas. I'm JD Weinstein. Raj, thanks for the great intros. I highly recommend anyone in the crowd listening here to take Raj along with you to any events that you do, because it'll make you feel good about what you're doing. So I head up our VC presence within the Oracle for Startups program, and really the goal is how we help our startups in our portfolio and community scale with all of our enterprise resources, unlocking the enterprise with customers, integrations, press, our technology, and then also with capital as well. So we play a lot of the middleman or middle women as well between some of our startups and investors. My background has always been with supporting early stage entrepreneurs, mostly through investing. And so most recently actually was running corporate venture capital for a firm out of London called WPP, large advertising conglomerate, but have done things with early stage accelerators all the way to the growth stage as well. So we're really excited to kick things off. And, I thought what would be interesting is really to dive a little bit deeper into, what are some of these keys to running a successful fundraising strategy and a pipeline. And so, there's a lot to talk about, I think, after when you're negotiating with investors. What do they look for, in your company? What do you need to do to prove things out? And, I think not as much paid attention to how do I just even where do I even begin? Where do I gather all these investors? How do I track them? How do I communicate with them? How do I move them along the pipeline? And so that's a little bit of what we're going to talk about today, but certainly not limited to it. Lars and I will run through a deck for about 20-25 minutes, hopefully entertain you, keep you all awake before you're off to happy hour or dinner there. And then we'll jump right into Q&A alongside Raj. So with that, Raj,
I will bring this up on to the screen for you guys. And just to the audience, if you guys have any questions you'd like to ask Lars and JD during the Q&A at the end, jump onto the chat tab in the top right-hand corner, click on the Q&A and list your questions there, and we'll bring them up at the end of the presentation. Let me bring up this PowerPoint for you guys now.
Or we'll give you a little bit of background just so you can see I'm actually in Texas there. Excellent.
All right. So, JD, if you just want to give me the heads up when I can go through to the next slide.
Yeah, you can kick over to the next one. And I think, Lars, we'll run through this and kind of go back and forth, but you're, more than welcome to cut me off. You as well, Raj, whenever you see fit and have an inkling of knowledge and information. So like I said, we're going to talk a lot about what are some of these keys, and then beforehand set the stage. I think we'll probably go through for about 20 minutes or so and then kick it over to the most interesting side of things and answering some of y'all's questions. So to begin, Raj, we can get to the next one, and hopefully the active, just to set the stage with understanding a little bit of who you are in the audience. It'd be helpful if I figured this would be a good system anyway for Lars and I to gauge sort of where we'll guide the conversation. A lot of what we'll talk about will be relevant for any time you're fundraising and in any stage of your growth. But, if you could throw a 1, 3, or 4 into the chat, if it's open, wish we could see you in person and ask you to raise your beer or something. But you'll have a if you're looking for pre-seed angel funding, we'll call that less than 500K in terms of pounds, dollars, whatever currency you're using is. That's what I think we're probably looking at, maybe most kind of first checks in. Secondly would be, seed rounds if you're looking for institutional capital. And so call it anywhere from $500,000 to $2 million. Series A is going to be around that 2 to 10 million stage. So really finding product market fit and fueling the fire, and then B, obviously growth. Okay. So we can kick over as those trickle into, just so if we see a wide variety. But I figured we most of this stuff we'll talk about is going to be much more geared towards that 1 and 2 stage. Raj, you can kick over to the next slide. Cool. So before we get into some of the tactical conversation, here's a couple interesting, I think, wise words of fundraising, and probably metaphors that maybe some you have heard of, maybe some you haven't. Some are popular, some are not, here in the States especially. And so I think it's helpful to give a new and different perspective to the fundraising landscape. And so, number one, just off the bat, just understanding, like, as we're entering into this VC funding game, how do we get here? Why do you want to raise money? So venture investors, understand are in the business of selling money. This is what they do. They are a middleman, oftentimes, between their limited partners that give them money, hundreds of millions or billions of dollars to invest into you all. And you're going to get that same money or dollars to fuel your growth anywhere you go. They're selling this money for a pretty expensive price, right? It's part of your company. And so understand that that is really the mindset you should have going in here. They're the commodity of trying to put dollars to work. You're the one with the valuable business. The next thing is going to be investors, invest in lines, not dots. And so I really love this because, very rarely will y'all show up to an investor meeting and say, hey, great meeting, and they'll go, maybe, where do I wire my check? Where do I give you my $1 million of funds? Do you have your banking information? Well, I wish that was the case more often. It does happen every so often. Lars, with him if he's up there pitching. More frequently, it's going to be a little bit of a journey, right? And call it anywhere between 3 and 12 months of meeting over time. And so each dot that you're going to meet with an investor, they're going to want to get to know you, and they're not investing in any particular meeting point, right? As you show up, what they're really looking for is how you communicate, how you think, how your traction looks over time. And so they're investing in these lines. Hey, you went through a tough time or a founder divorce, you bounced back up and you're still running with the company. These are the kinds of signals that they're actually looking for. So that's important to take into account. All right, the next one here we have is every tall skyscraper needs a strong foundation. And so you really need to choose some of your earliest investors wisely. And so think of the fundraising process as, if we're building a skyscraper, if it is tilted a little bit over to the right early on, that building is not going to make it far before it crashes and burns, right? And so, the foundation is very much the most important part, because when you get up here and stuff, you can make a lot more changes and things will work. But choosing your earliest investors to be your best champions and best supporters and partners in this, call it 10-year or plus journey, if all things are going well, it's important to evaluate from that standpoint. And then moving right on, again, I'm just going to browse through these kind of, we'll call them iterisms. Ask for money, get advice, and ask for advice, get money. By the way, we'll definitely provide you this deck and things. Raj can answer in the chat around recording provided, so don't worry about it if you're kind of scrambling, taking notes and things. So what this really means is a play to, the psychology of raising funds. In this, as cringeworthy as it is, many times you'll hear folks compare this to the dating process. And so you're going to be dating in this stage for a while. And there's a lot of psychology that goes into, nobody wants someone that shows up begging for everything or just lays all their chips out on the table and says, I really need this. I desperately need this. Our company's going to die. Give me funding so we can grow and then hopefully make you some money. It's not how it works, right? And so, folks like to feel engaged, wanted, critical in your business. And so when you have this approach, if you're meeting a VC, it's pretty clear why you're there due to the nature of their job. And so you don't really need to lead in with, we need money from you. And so really dive into the business, get them hooked and excited, and ask thoughts and sort of deep dives where it might be most interesting to them. Last couple here to round out our wise words. Don't get caught up in the glitz and glamour of it all, right? There are a lot of headlines, especially now more than ever. Highly recommend going and watching the WeWork documentary if you haven't already. Seen Theranos, we've seen other things happen where also it seems like every other day a new company has raised $1 billion. This is one thing you want to be really actionable as to why you're going to be raising money, and don't get caught up in what your competitors and everybody else is doing, what the headlines are saying. An important thing to note is that it is true that much more money is going into the venture ecosystem. I think the stat was something around, we matched or even surpassed all of 2020's venture dollars in the first quarter of 2021. While that is true, it's going into smaller companies at the growth stages. And so don't get this wrong. When you look around and say, wow, it seems like everybody and their grandmother is getting funded and raising their seed rounds, no problem. I read all these things in the news every day. It certainly still is very, very difficult. And you all are the true superheroes taking this on and going out to build your businesses and hopefully change the world. And then the last thing here, I just briefly mentioned around why are you raising? This is important, okay? It should never be because it seemed like the right thing to do, or it seems like I have a venture-backed business and everybody's kind of saying, oh, well, this is part of it. You raise money for your business. Bootstrapping or not raising any money, if possible, leads to limited resources and then better decision-making, and then therefore long-term better outcomes. And so when you're not super flush with cash, that's when actually many times the best decision-making is happening. And it's important to raise the right amount, right? I know Lars and Raj will touch on this sort of later on, but around raising responsibly, right? You don't need to go out and raise 50 million seed rounds just because a lot of people want to give it to you, unless it makes sense for the business. Competing with SpaceX and rockets to Mars or something, right? Great. Well, I'll pause there. I don't know if Lars are on raising responsibly or anything else before we jump into the next year.
Not just yet. I have a lot of comments to the next point about how you raise, because if we jump on to the next slide already, one of the things that I very much have found working on the ground, whether in Scandinavia, the UK, and other parts, it's leading on to what you're getting onto here in terms of the options. Because let us be absolutely clear that there's a lot of governmental funding options out there. And I think, JD, you and I probably tend to get caught up in those big professional VCs, whether it's Amadeus Capital Partners or Wellington Partners or DN Capital, or some of those that a lot of that have 5-7 unicorns behind them. It's also a matter of currently, for example, the UK with Brexit. I know of a tremendous amount of funding that is coming now through public sector, through central government in the UK, through even down to the healthcare NHS, if you have anything that can help save the lives of patients, etc. Definitely be imaginative as well, because a lot of what some of those governmental parts bring is not as restrictive as what you just mentioned, JD, exactly around this. Well, don't raise too much because you get to be, I suppose, too much up in one particular venture capital or a set of venture capitalists where they want to decide everything. I have generally found that those governmental contributions don't ask the same type of requirements when it comes to them wanting to control you. They do lean on, and probably a lot of them will say, we match what you privately can raise, we will match that. So that somehow you need to show that you can go and appeal to the corporate VC side and raise something there, and we'll match it. A lot can be said about that, but just do not forget to look at what corporate, central government, how they can complement one another, and whatever country you're in, how various schemes that currently have been launched for the sake of promoting small, medium-sized business, Brexit again, UK, how can we promote that you get funded in this country and you are inked in this country? There's a lot of money to be found.
So I think, the last piece on designing your fundraising strategy before we go into really a CRM system and how do I communicate and track investors. You need to know how much money you want to raise. So maybe we weeded that out and you went, hey, I actually don't need to raise as much as I initially thought because, I really just need to hire 2 engineers to build out the MVP of my product. or now we want to do 100K to run X amount of campaigns in a growth marketing setting. It's really important to assign dollar values. Now, these will change, but what's important for investors is they get to evaluate your thinking patterns and how you're going to leverage and use this money. Being scrappy and cheap, especially at the very early stages, is a really big bonus, and I think probably characteristic that investors look for. So keep this in mind as well. And as Lars mentioned, also there's just a lot of different ways to raise capital today. In today's market, it's getting more and more creative. And so traditional venture capital, angel investing is what we're going to really touch on, diving deeper. But it's worth mentioning, if you haven't evaluated some of these other creative ways, it may make sense and actually may be cheaper to raise money that way. And so whether it's crowdfunding, there's different syndicates like Republic or Angel List that have popped up that are very revenue-based financing, folks, investing. If you watch Shark Tank, this is Kevin O'Leary's way of saying every dollar this thing returns, I want to get 20 cents back to a certain degree. Government grants or other foundations that are, if you're a mission-driven business, an impact business. Of course, customer revenue is the number one thing. That should have been, before we even started, can customers fund this thing? You get prepaid pilots, so on and so forth. Debt from banks, of course, family offices, different angels, high net worth individuals, and then finally, venture capital. So let's drive on to the next. We're going to talk a little bit about a racy word in today's world, which I'm typically very cautious on sharing, profiling my investors. So while it's bad to probably profile people in other ways that you hear in the news, this part of profiling is okay. And it's important to do as much research and diligence as you can on the investors that you're looking to target. So here are a couple bullet points that we'll just run through for y'all. Value investors versus unicorn. And sometimes it's going to be a mixture of both. You'll see a number of companies in their portfolio at different rounds that they've done. And then, of course, price sensitive kind of is usually equivalent to value, price insensitive to unicorn. And so, meaning, are they looking at, hey, I want to see de-risk the business as much as possible. I want to see you get to $100,000 monthly recurring revenue. I want to see 20,000 users on the platform. I want the tech, working sound over time. These folks, as they look later and later, they're going to pay a higher price to you because you're proving different things out along the way. And so they're looking for maybe what's a value what's the best value I can get into this business. Others, which is typically what the venture model is designed to look like, are looking at unicorns and breakthrough innovations. And so that's evaluating asymmetric risk reward. And so, an example of this is like an Airbnb or an Uber. A market doesn't exist. Rather than pitching, I want to get and take over 1% of the market, you're actually pitching, I want to change human behavior and create an entirely new market that doesn't exist and own the whole pie. Everything that we've seen, even the early days of blockchain, look like this, right? There's a high chance that this fails and people don't adapt it. But if it does work, the returns are so asymmetric. So, 100x, 500x, 1,000x. Coinbase that we just saw, I think the early investors that led the seed round, 2,200x. So these are pretty insane multiples that we're talking about. And then moving right down here, a mission-driven business, even if, like, let's say you find, not talking to a family foundation, we're talking to a true venture capitalist where returns are the number one priority, but they may also have a component of we're investing in clean energy or climate change or sustainability. Maybe you fit the realm, and so there's a natural point there. And maybe there's something or a part of your business that fits that mission that maybe your investor's on. So there's always ways to tweak your pitch depending on who you're meeting. And then lastly is going to be the founder criteria. So are there non-negotiables, one of a venture capitalist I looked up to most here in the States, Bill Gurley, that works with Benchmark, really famous for leading Uber and a number of other companies. He mentions you got to go through some sort of hardship as a founder for us to invest. So you have had to have had a near death experience with the business, meaning, have you run out of money and you made it through? Did you have a founder divorce early on or have to go through some high turnover in management? And how did you bring that back together and keep going forth with your mission? Because these things are going to happen time and time again. And so really it's a test case of, hey, are you committed to this thing? And have you gone through a battle before? Because there's going to be many more to come. Some of these things are easy to find out, some not so easy. The best thing that you can do is meet the portfolio companies that have raised money from those investors. And so, we found out this community that you have in Startup Grind, but also a community of entrepreneurs that are trying to do interesting things with their businesses, tend to be pretty open around sharing, hey, this is what I thought with this investor, this is what happened here. It's kind of the founder head nod of, hey, we know we're in this together. It's very difficult. And so keep that back in mind as you're raising. All right. Can shoot on over. Okay, so all of this that we just mentioned was building up to really the last version of what we want to talk about here today, which is, okay, now I'm in the right mindset. I've decided, JD and Lars, Raj, I want to raise money for these reasons. I know why I'm raising. I've chosen I want to go to the venture capital route. I understand that their incentives are they need to have multi-billion-dollar returns. I'm shooting for the moon. I want to change an industry. This is alongside what my character and what the business I'm trying to build aims to do. And so now, where do we start with a pipeline and then a CRM? So I'll credit to Techstars. They have a fantastic toolkit online that we can send out after this. Not trying to recreate the wheel. So for that second graph where they show how do I actually track the checks and things coming in. But beforehand, there are all different types of versions of this. And really our goal today, between Lars, myself, and also Rob, was can we give you some tactical tools to at least start, if I've not raised money before, or maybe I'm just kind of going back and forth, I don't really have a system down, how to manage this whole process. And so the first chart right there, the first chart is really towards targeting the right investors. So doing your work up front and tracking how to get to them, what do they look for, what's interesting, what are the intersections, we'll talk about that in a minute. And then the second chart there is really, okay, now I'm starting to talk and ask for checks, and I'm getting into second, third, fifth, 10th meetings. Who's actually committed, who's passed, how do I walk them through that process? So the first one right off the bat, I've labeled a number of these headlines. Again, there's no right way to do it, but here's a great starting point if you haven't done something similar to this. As you can see, it's on a pretty simple Google Doc. You don't need to go crazy. There's a million tools out there, certainly, that you can use. You can see advertised. Don't go crazy. Stick to the fundamentals and stay focused. So, looking at your interest level, the name and the VC firm, you may have a couple other bubbles in there as to what's their average check size, maybe, equivalent portfolio companies that seem interesting. An important chart column here is going to be the seniority. So when you're meeting with sort of your analysts and associates, it's still great. It can be interesting, but understand that they may not be the key decision maker to investing in your company. And so in order for you to actually achieve an investment from a venture firm, what you really need is a partner or a decision maker to stand behind you. So that's an important one. Where are they in terms of a hot lead? Are they a warm lead where it's someone maybe I kind of knew, maybe it's one of your best friends or you've done business with a company before that's a startup, has funding from a particular VC, You all worked at Oracle at the same time, has great things, has seen your work ethic, everything you need to do. This might be a great introduction into that VC. And so how are you going to get there? You know, a potential intro from is also strong. We see a lot coming out with VCs wanting to say, I'm open for business. We accept cold decks. We look at pitch competitions. We look at deals every which way they come to us. Keep in mind that very much so they need to de-risk the investments. And I'd say still that this is not super sort of data backed, but from the venture investors I talk to on a very regular basis, the majority of the founders they invest in are previous founders that they already know or from the network, or potentially, you know, worked with before or have gotten to know over time. And so while doing cold intros and different things, or just kind of cold introductions, I think, or reach outs is a strategy, it's going to be a much lower conversion. So potential intros from why, think about, do you fit their thesis? Do you fit something within a partner's thesis? Remember, you're looking for the partner, a person to invest with you rather than the firm. Each partner really carries their own weight in their own business in the venture industry. And then, of course, notes and meetings. And so walking alongside, you know, what happened with particular meetings, what do you need to do to prep for the next ones? Keeping this all even and symmetrical is great. The number one question I'll end with on this chart is going to be often, and I think folks, you can throw it in the chat or raise your hand or laugh to yourselves, because I think you've probably heard this before, where you present your business and an investor goes, wow, this is really interesting. Thanks for sharing. It's incredible what you've done. It's a little bit too early for what we're looking for. So why don't you come back and keep me in the loop, maybe in a couple months or so on. And your answer to this sort of soft rejection, which will frequently be the case, should always be, great, thanks for that. Do you have feedback for me in what would you like to see for this to become an investable business in your eyes? And so, you know, you get to gather data of what do investors want to see for them to put their money in your company. Is it a certain amount of MRR, monthly recurring revenue? Is it a certain amount of daily active users or time on the platform? Do they want to see you build out another product? Doesn't mean that they're right. You know your business better than anybody else, but what it does mean is you can pick up on trends and really evaluate, pull together different information of how investors think about your business. So let me pause there and see if, you know, Lars, you have anything to add, or I can finish us through the marathon here with the chart on the bottom.
You can finish us on through. I think part of the whole CRM on investors, let me also appeal to segmentation, because a lot of you may not be aware of how much corporate venture capital there is out there. To give you an idea, Allianz in Germany, 1 billion euros, if I'm not mistaken, in venture capital. AXA Venture Partners, I've worked with Imran there in the UK as well. So very large corporates now tend to have an accelerator arm and a venture capital arm. They're not affiliated, but if you somehow can get into, if you are working in mobility, then BMW iVentures might be of interest. BMW Startup Garage is the accelerator. You can always find ways where once you begin working into these thoughts and topics that I again will appeal to that are quite vertical, you will start to have a network and you'll start to be known. If you work with an accelerator, then within that accelerator that might have a vertical focus, you might appeal to a vertical venture capital arm of a corporate. So please don't disregard those as well. There's a lot of money to be had, and that might lead directly onto customers. We can't keep talking about customers. I know I keep doing it, but if you work in the VC arm of a large corporate with mobility, for example, within BMW, then the chance of you getting close to that corporate deal or proof of concept that could be with one of those big global brands that is going to further enhance and enlarge your ability to raise more, you've paved the way for that at that stage.
Yeah, this is a great point, Lars. Especially what we see day to day working with, massive enterprise customers. A lot of times this is the conversation, Lars, myself, and I know I saw Matt Price, a special shout out to him. He's on our team leading some of our business development efforts in the EMEA region. We see and talk to CVCs all day long. And so, most large corporations have sort of an investment arm. And so another category to take advantage of on, okay, what are the many ways that I can raise money? Segmenting your business is really important. And then also just focusing on who the particular partner or investor is. You're going to describe your business in a different way to them, right? Depending on what their criteria is, what their mission is, so on and so forth. Awesome. Love to see Matt Price shout outs too. Highly agree. So to bring us home, it's, this is pretty self-explanatory, but another just version of building your own CRM. This is not rocket science. You all are in the business of getting customers and selling your product. And so you very much can think of your fundraising process very similar to what your sales pipeline and sales process looks like. Don't tell investors that we're sharing this on the call right now, but in terms of your own targeting and profiling, managing, and going through the system, it's a really good approach to think about this. And so on the bottom here, this is going to gauge, okay, do I have a new investor coming in, right? How many folks want to come to sort of the next stage of, you could call it diligence or advancing, right? So maybe you have, hey, they've crossed out these things in these buckets, so they seem like a really good fit. Soft circled means that they've committed. It said, hey Raj, great, count me in for 100K. They haven't given you the money yet. The money is not good until it cashes in the bank. We've all heard that story way too many times. So very important, you don't put that there into wired, right? It's going to be soft circled, committed actually. So soft circled is, yeah, you can sort of count me in for this. Committed in legal paperwork, committed is probably a formal yes in an email. Legal and paperwork is, now I've actually signed the docs. Wired, the money, you can see it in your bank. It is not an investment in your company until that checkbox is checked off. And then of course passed, right? Getting to a quick no can be as crucial to getting yeses and into the right investors' sort of mailboxes and meeting times, right? You don't want to waste your time dragging along, meeting an investor 12, 15, 20 times. As soon as you see that, hey, I'm not sure this is going anywhere, reprioritize. So this is a really effective sort of strategy and something you learn over time, but something to keep in mind that you only have so many hours in the day. You are literally building a business in your company, and fundraising is a whole other full-time job. And so make this as efficient and slam dunk as possible. And that's what we're here to help you design a system for. So with that, I think we knocked it all out. So thank you. I hope everyone's still got eyes wide open in the audience here. We can't see you. Yeah, we could the next slide, Raj. I forgot on this. This is just some material prep. So I'm going to turn it over to questions because it's important that we get that from you all. But some things to design your own little package of materials, right? So very, very quickly, we talked about investor pipeline and the CRM, having an affordable intro that you can give other people to introduce you in your strongest suits of your company to potential customers, investors, what have you. An emailable deck, meaning, hey, when you email something, you know whose hands it's winding up in. So be cautious with that. It's usually shorter, maybe, but also meant to be read and written on. And then a presentation deck might have some more sensitive information like a financial model, so on. And then your diligence docs and data room. So legal stuff and updated cap table, that's going to be, a little bit later stage once you're really deep in the process with an investor. Great. So Q&A is open on our Q&A tab. And
So while we are getting on to some of the questions, and Raj, surely you will have some as well. Can I just go back to the very first comment you also made, JD, about raising capital because you want to hire 2 new developers? I want to make sure that I get the whole salesy bit across as well. Please do not disregard when you talk to venture capital, because they are going to look at your traction. They're going to look at your total addressable market and you selling. Make sure you appeal as well that some of this money is going to be used to hire salespeople, because you as a startup talent for app development, for data science, you might be a great founder, but a lousy sales guy. And that's going to shine through when you raise money as well. So really, really take a look at yourself. Are you a good salesperson? And make sure you appeal to the sales when you address a venture capital guy as well, because they want to see that traction. And then you can rig all kinds of commission statements for a very expensive sales guy, where he's going to get 25% commission on a deal he makes, so that he's going to be cheap on a fixed retainer to work for you. But make sure you have answers to that, because that's how you're going to grow, and that's how they're going to make their money X back 10 times as they want.
That's great. Awesome. Well, again, thanks. Thanks. We'll let you jump in and sort of run Q&A maybe for the group for the sort of final 15 minutes we have.
Sure, yeah. Firstly, just want to thank Lars and JD for an incredibly insightful presentation. I mean, I personally, with my previous ventures, have been through the fundraising process, and had I had sight of the wisdom and the guidance that Lars and JD has just shared with me, you know, it would have been a totally different journey. So, I mean, I think everybody in the audience today is extremely lucky to have been able to sort of get visibility of the incredible insights that Lars and JD have shared with us today. And so I'll open this up to the audience to pop their questions in the Q&A box. I've seen a couple coming up in the general tab. Guys, if you could, at the top of the chat tab, there's a little button that says Q&A. If you can drop your questions in there to ensure that they do get addressed, that'd be awesome. And we'll go through and pick a few questions for Lars and JD to address. So let's start off with Julian's question, which is, what would you write in the one pager that you put out to VCs?
Yeah, so I think there are different instruments that you can use, and always really having. So when we talked about that last slide, we went through it really quickly, but these are things that are going to be for every investor that you meet, and you're going to release them at different times down the process. The one pager is comparable to the deck. I think what's interesting about that, it's thought of to be maybe a little bit more old school. What I typically recommend is having a sales one pager. Collateral, very comfortable, that can have an executive summary, what your business is, problem, solution, customers, and sort of really addressing the solution that you have or addressing the problem that you're solving. This is a great tool to be able to share around with folks. To say, hey, by the way, here's our one pager, you know, this is our sales. I think equally as important to, here's your pitch deck, here are the terms, here's the industry we're targeting. Think about the difference between the two.
Okay, awesome. And Lars, anything you'd want to add to that?
Said it all, JD.
Got the experts in the house. Okay, so another one that's popped up from Nimi, who's mentioned that his startup is in the mobility industry, and really interested to hear about BMW iVenture. Lars, as I mentioned, you are our super connector in the house today. So how can Nimi potentially get in touch with you and introduce his startup or her startup to potentially have the introduction to BMW iVenture if you know someone there?
Reach out to me on email and I'll forward it both to BMW Startup Garage, the accelerator, and make an introduction into the iVenture side. Wow. I've had face-to-face meetings with the iVentures in Munich. It's a great team.
Lars, you couldn't be any more useful. Nimi, so do reach out to Lars.
I can be found on LinkedIn, or will get somehow through you, Raj, the details for me.
I'll drop my email into the general chat box so people can indeed reach out. So moving on to one from Ignas. This is an interesting one because it's something that's really coming to the fore with a lot of corporates. So it's around moonshots and whether they're popular with UK investors. I know, JD, you do cover the US landscape, but if you have some insight into the UK market, that'd be awesome around moonshots.
I'll let Lars kick it off, and then I'll share my 2 cents on this as well.
Sorry, I was actually just answering an email or an incoming message from James McKay, who had asked me a question. So I was just sitting typing away there.
So
I'll let you include it, JD.
Yeah, are moonshots popular with UK investors, or maybe even difference between UK, EMEA, and landscape of maybe what is glorified, what we see mostly in the Valley? Yeah, so what I see is, actually where I'm based here in Texas, and familiar also with the middle of the country landscape in the US, it's probably much more similar to the investment landscape in the UK, in that you are not going to, they happen sometimes, but, whereas in the Valley, you see $20 million seed rounds pre-product, and, or Clubhouse, for example, is a great example that reached the $1 billion valuation with, 6 people and within a couple of months. It's not as common to happen, right? I think there's a lot of hype and FOMO, equally interesting products and people building these things that can scale really fast. What I'd say is, focus on the core fundamentals of your business. And, what I think investors typically look for in sound investors, they want to see a couple of scenario-based planning. So the most important great investors ask, what could go right? And so you need to show that this is a moonshot and this can be the multi-billion-dollar company that they're investing in, right? At the same time, the conservative angle, this is a value investment. Even if we get this amount of funding, even if we only achieve X, Y, and Z, it's still a very strong business. And so we're shooting for the moon, but by the way, here's a case in a scenario where it's still going to be value add. Sorry, I don't have a more clear answer, but in terms of addressing, your situation with investors, that's how I'd go into it.
That is very, very insightful. Appreciate that. So
yeah, 2 cents on that. Just being in the UK market, it's a little more conservative, but still, we see plenty of unicorns that come up over there, and so it's very active.
Indeed. And perhaps this one might be one for Lars. It's from James McKay. So being the super connector in the house, does Oracle for Startups help find management personnel for startups as they're looking for a female COO to run their startup for them?
And I was actually just him, I was complimenting that very search he has. So first of all, having that whole focus now on inclusion, that has so many parts to it. So the gender inclusion is starting to be silly important. I've personally worked a lot with January Ventures, with Maren, who runs that. She invests only in female-founded startups. We have all kinds of events where JD, myself, Matt on this call as well, we need to bring forward female founders that are part of, we just had the, I think, National Women's Day or something like that. We just had a large set of events that just kicked ahead. It is important. It's important for us. It's important in how we want to also be seen as Oracle and you as Google Startup Grind to be inclusive, etc. So we take part in those very large agendas that are out there. So as a starting point, compliments on the fact that we actually don't go and contribute when it comes to finding the actual people or locating them. With a bit of luck, that could even be a business idea for the sake of inclusion. If you want to create a management team that has the right inclusion, whether that is geography or gender or anything like that, I can certainly only ditto that it is super, super important also when you want to get to you progressing, because you might have competencies that you can rely on, where nepotism for the sake of you being in a certain gender or ethnicity or geographical range will really play to your benefit.
That's brilliant. Thank you so much, Lars. I think that's very, very useful. And I think the diversion and inclusivity factor, as you said, it's really, really important, and can really, add value to your startup. So last couple of questions, I think, before we wrap up, and these may be ones for JD. So from an investor's perspective, what creates the most FOMO for a deal?
So different people, different things. There's one insight that I'll share sort of behind the scenes and from an investor's perspective. The thing that drives an investor the craziest is seeing a deal announced and funded in the news or somewhere else without them knowing the deal. And so, investors, their goal is to know and see every single startup that is in the region or in their thesis. So, there's kind of these famous things where Sequoia or I think have the anti-portfolio, the companies that they salute that they passed on. If it's Airbnb, maybe Stripe, Twitter, meaning that they did meet the founder, but they chose not to invest in the company. That's okay. That can eat you up a little bit when they get really big. The craziest is just not being able to see.
Interesting.
And to comment that, I know something that drives investors super crazy, because I'm pre-IPO investor as well. And in the pre-IPO documentation was listed a corporate customer that no longer was a customer. So be super, super honest with your install base of customers. Confidence drips in. I think, JD, you've heard our big boss Jason talk about this. Confidence drips in but leaves in buckets. So when you want to win over with confidence your collaboration model, whether it's anyone in the ecosystem, whether it's an investor, anything like that, you do not want to get bad press. Those guys who say there's no such thing as bad press, forget about it. When you're a startup, you need only good press. You don't want to be in anyone's bad books. And you do want to be super honest about how far your solution is. It's like you're selling a bicycle that you're still building, but you're actually riding it yourself. So that whole, how do you boost it? What Reid Hoffman, who sold off LinkedIn, is talking about in part of the work he's doing. But when you blitz scale, when you communicate, be blissfully honest about what you can do, what your solution can do. Is it alpha, beta, theta? How much development need are you still in need of? You cannot lie. You cannot bend the rules even 1 second. I'm thinking about suing the entity that I've invested in, because in the pre-IPO, they had a huge global customer that was no longer a customer of theirs. They have lost my confidence forever.
Very, very insightful. Last question, I think, before we wrap up, and as much as we'd love to have talked about raising responsibly, I think that'd be a whole new topic for another day, Lars. From Yevgeny, he wants to know whether a written business plan is still important for VCs or even CVCs, corporate venture capitals. And if so, how detailed should they really be? Perhaps that's one for JD.
Yeah, so my basic answer on this is, written full-on business plans that you typically see kind of in the older days or very much taught in business school in traditional settings are very, very useful for you getting insights into your own business. And so going through these exercises, writing out, doing the market research, a 30-page report, and pulling all the data you can, I think is extremely helpful. In terms of, VCs and CVCs, it's changed quite a bit. If you just think about the day-to-day of an investor behind the scenes, there's not a whole lot of time to evaluate at the earliest level for a company. What's most important, especially at an early stage, is the team and that they believe you can execute, because all the financials and all that data and stuff that you're putting into that, written investor or business plan, the only thing we know for sure is that it's going to be wrong. The numbers will be wrong. What's important is that your thinking patterns are there, right? I've said this a couple of times, and they're evaluating how you are and how you plan as an entrepreneur. So do it for yourself. Don't share it with the VCs, but make sure that you get a really clean deck that you're comfortable with. There's a lot of great resources to do that with.
Okay.
And I think one important thing, Raj, expectation alignment. If you somehow can find out how the venture capital that you're talking to will evaluate you, because they can be as different as night and day. JD, you and I talked about, so is it the 7 T's? Is it the team, the total addressable market, the TAM? Find out how they are evaluating you. And if they are evaluating you where what you just asked, Raj, is important and how detailed it should be, you need, for the sake of meeting their expectation, to bring that along. So if you ahead of time can somehow find out from the inside, same as corporate selling, get a friend on the inside, find out what is it that's expected of you before you even enter the door, then you have come quite a few steps up already in passing some of the thresholds that they'll evaluate you on.
That's right.
Awesome. Lars, JD, some awesome insights there. Thank you so much. Whoever was lucky enough to attend today, I don't think a better opportunity could come when it comes to fundraising for your startup. So to both of you, thank you so much. Really appreciate you taking your time out and providing such rich insights. And if anybody wants to connect with JD and Lars, feel free to jump onto LinkedIn and shoot them a connection request. Phenomenal guys to have within your network. And thank you all once again for attending this event.
Thanks so much, Raj.